to establish if information that has been provided in these reports, in the financial statements, which is the information, has been provided in a process that is in accordance with the generally accepted accounting principles. I repeat, the purpose of an audit first is to look for evidence. Perhaps before that, let me say that management will prepare financial statements on a monthly basis, and those financial statements will be called management accounts. They help management in the decision making on a daily basis. Then at the end of the financial year, after 12 months, he prepares financial statements out of which is called the annual financial statements with the actuals now. And those actuals, the annual financial statements, are made up of the income statement, statement of financial position, the statement of equity, statement of cash flows, relevant accounting policies and notes, and disclosures. And there's the standard which give guidance on how to prepare financial statements at the end of the financial year. Those financial statements will then be brought, we call the auditor to come and check if the financial statements were prepared, give a true record of what happened during the past 12 months. The auditor will then perform what is called an audit, which is the reason why we are meeting in principles of auditing. We'll perform what is called an audit, which we defined as the accumulation and evaluation of evidence that these financial statements, which we refer to as information, were prepared. That means the whole process of preparing the financial statement, arriving at these totals, was done in accordance with the generally accepted accounting principles. Are you there?
Yes, sir.
And the auditor will accumulate this evidence through observation, looking at how people work, through interviewing people, through sampling data and getting transactions, through many other methods which we'll discuss. Or what is evidence and how is evidence? What are the sources of evidence? How do we call evidence? What is the purpose of the evidence? The purpose of the evidence is to give information, is to attest, is allow the auditor to verify and to attest that yes, indeed, the financial statements were produced in accordance with the laid criteria, and this criteria in this particular instance where we are preparing financial statements is called generally accepted accounting principles, which are encapsulated in the IFRS. Once the auditor has done that, he satisfied himself that he has 4 types of opinions, four types of opinions that he can express, or how does he view the financial statements as reported by management. First, we said the auditor can produce what is called an unmodified opinion. An opinion, and also called an unqualified opinion, or he can produce an unmodified opinion with explanatory paragraphs, or he can produce an unmodified opinion which is clean, which effectively says, I've looked at the financial statements according to what I saw when I got there through the processes that I did as an auditor. I'm convinced that management, indeed, they have followed the generally set accounting practices. And I don't think there's any material, there's no material deviation, there's no material error in the financial statements. Perhaps at this point, we can try and define the word material, which perhaps some of you is the first time to hear of the word material. Are you there?
Yes, sir.
Yes, it's important for someone to comment so that I can check whether my connection is still on. So you would meet the word material, which is a very important term that you'll be meeting quite often under auditing. In auditing, when we say material, we say something is material if omitted or included in the financials would give a different interpretation of the financials, different understanding. For instance, if a figure was omitted in the financial statements, if we omit a figure in the preparation of the financial statements, and we interpret the financials, we arrive at conclusion X. When we include the figure in the financials and interpret the information, we still arrive at conclusion X. Then, if excluded or included, it does not change the conclusion we arrive on the conclusion, our interpretation, our understanding of the financial statements. Then that thing is immaterial. It only becomes material if its inclusion or exclusion, its omission or inclusion in the financial statements affects our conclusion on the financial statements. Are you clear what materiality means? We'll go to more complex one next semester. So in an unmodified opinion, the auditor is saying that he does not think that there are any, he gives a reasonable assurance that there are no material issue, there is nothing material that he has omitted, such that if there is anything that has been omitted, it would not give any effect on the decision that will be made out of interpreting the financial statements. That is a modified an unmodified audit, which is also called an unqualified audit opinion. And when most organizations are looking to have an unqualified audit opinion, which kind of says, yes, indeed, we have prepared the financial statements in accordance with the generally accepted accounting principles. We have disclosed everything that needed to be disclosed. And therefore, the auditor is happy that the criteria, which is the generally accepted accounting principles, was properly followed in the preparation of the financial statements. That is what you always hear people saying, they got a clean report. They mean it is unmodified.
Hey.
Yes, madam. Someone wants to ask. Can you ask? What I've said previously, are you there?
Yes, sir.
Yes, sir.
What I've said previously, ladies and gentlemen, is that understand that the more you talk, whether in a lecture or in a meeting at the office, the more likely that you are going to be promoted. People get paid for what they say, not what they do. Yes. So the next report that you can come up with when you look at the evidence that the preparation of the financial statements and whether they were in accordance with is what we call an qualified opinion. You may qualify. You may say that, yes, I looked at the financial statements. In general, they seem to be in acceptance. Generally, they were prepared in accordance to the generally accepted accounting principles. But except for the following areas that I feel that these areas were not in order. Were not adequately done, but except for one to highlight that the areas of discomfort that the auditor had, that is called a qualified opinion. And perhaps before we go to the others, let's finish with the unmodified opinion, which is what we call a clean audit opinion. We are auditing. When we audit, we need to give a report of what we saw during the course of the audit, as we accumulated and evaluated evidence. There are four things that we can speak, that reports that we can issue: an unmodified, a qualified, an adverse, and a disclaimer. There are four reports that we expect from an auditor. If he gets into your building, there are four reports that he can produce. He can produce an unmodified or a qualified report, a qualified report, an adverse report, or a disclaimer. First, we have to say an unmodified or a clean report must meet the following conditions. As the auditor accumulates and evaluates, must meet. Everything must be clean. All the financial statements must have been evaluated and must meet the criteria. There must have been sufficient and appropriate evidence that has been collected and evaluated by the auditor. The financial statements must be in accordance with the generally accepted accounting practices and any appropriate framework or legislation that will. There's no circumstances that require us to emphasize some exclusion or inclusion or modification or anything in the financial statement. Everything is hanky-dory. Everything has been done perfect by the preparers of the financial statements, and the auditor is expressing a clean opinion. So these four, it must be with respect of the four of all the financial statements. Yes, your mic there. It sufficient and appropriate. Hello, someone has a mic on, please. Sufficient and appropriate. Hello, you are talking.
You're too fast.
Oh, I'm too fast. Okay, you were putting your mic on to complain. Okay, got you. Okay. Types of audit opinions. 4 of them. A clean one, a qualified one, an adverse one, and a disclaimer. We are going to look at what a clean opinion would entail. A clean opinion would entail that the information has been provided through all the required reports: income statement, balance sheet, cash flow, equity, notes, policies, disclosures. Everything is in 100%. The auditor has been able to collect sufficient and appropriate evidence to substantiate his opinion in all the audit areas. Sufficient and appropriate is for the auditor to determine. All we need from them is an opinion. They were placed in a position where it was possible for them to collect sufficient and appropriate evidence, be in the data, that means the transactions, the debit and credit, be in the internal control processes, the movement of documents within the organization, be in the observation of stock take, observation of internal control, everything. And the auditor has made sure that all the framework, all the laws requiring how to prepare financial statement has been abided to or on whatever. There was no area in which the auditor wished to emphasize to the users that emphasis of matter that there is a little bit of non-compliance or there's a little bit of everything has been checked and the auditor is 100% happy with it. Then he issues an unmodified opinion or a clean opinion. An auditor can issue an unmodified opinion or a clean opinion, but with an explanatory paragraph to say, yes, indeed, Generally, these people are doing things very well. The financial statements are all here. I've collected sufficient and appropriate evidence, but I have some issues with a few things. And normally the issues, example of issues that the auditor can raise that he may have would be lack of consistency in application of generally accepted. For instance, last year we valued stock, this year we are valuing stock using a weighted average. Last year we used whatever, FIFO, LIFO, FIFO, whatever. And that lack of consistency can have a bearing on profitability. There could be an instances of departure from the normal generally accepted accounting principles, which the auditor is in agreement with. Departure from the generally accepted accounting. For instance, there was a departure from how we do things because of certain circumstances. Then the auditor may decide that he must emphasize that although I'm in agreement with this report that is fairly clean, you can rely on, but be mindful that the preparers of the financial statements did not 100% agree with the general assessment because of these circumstances. It's just highlighting something. Or the auditor is saying that, yes, I agree with the financial statements, but you know, this company has a going concern issue. We are not sure that we will be trading in the next 12 months. The auditor may highlight that. There could be a matter that needs to be emphasized. Then the auditor will go ahead and emphasize such matter. Will go ahead and emphasize such measure in the parent. There could be other reports from the auditors that he's depending on, and he could emphasize that these other reports that came from other auditors other than him were not verified by him, but he's depending. In the event they have an error, he must be excused from that error. We are going to come back again to an unmodified audit opinion when I give you samples of opinions that we will be discussing as we emphasize the matter again more and more. I want us to leave this introductory part of the course knowing that, yes, we have the types of auditors, type of what, and when we issue an opinion, there are types of opinions that need to be issued. At least I'm creating a framework so that when I go deeper into other issues, at least we have an understanding of the terms that I'm going to be using. Modified or a qualified opinion happens under 3 circumstances: where the auditor issues an opinion and is modified or qualified. The auditor can issue an opinion where the preparers of the financial statements were not in compliance with the generally accepted accounting principles, and the auditor disagrees. Remember, if they were not in compliance and the auditor agrees, he doesn't issue he issues an unmodified, and he puts an explanatory paragraph to say, yes, they did prepare these financial statements without following due process because of and agree with them, and I'm highlighting this in the financials, but otherwise the financial statements give a true and fair view of what happened in the past 12 months. Are you there?
Yes. Yes.
Yes. The auditor may also issue a modified or a qualified audit opinion if there are issues relating to the generally accepted auditing standards. If there was a restriction or the auditor couldn't. Yes, madam.
Yes, sir. May you please repeat the first circumstance explanation?
The first circumstance explanation is, we said, our definition of an audit was that an audit is the accumulation and evaluation of evidence about how information was prepared and whether that information, in the manner in which it was prepared, it was in accordance with a criteria, and the criteria we said is called the general accepted accounting practices. The debits and credits and what, and assets should be this side, classified that, treat liabilities like that, treat capital like this, keep cash flows like this, those are the accounting practices that are generally accepted, whether that was that was how the financial statements were prepared. And if the auditor establishes that, yes, the auditor may establish that the general accepted account were not complied with and agrees with the reasons. If he agrees with the reasons, then he doesn't have to qualify. If he does not agree with the reasons given by the client, why they did not comply with the general accepted accounting principles, and the auditor disagree with the reasons why they did not comply, how they boxed the creditors, how they boxed the debtors, how they boxed all, if he does, or measured or disclosed, if he does not agree, he must issue a qualified opinion. First of all, there must be contravention with the generally accepted accounting principle. Secondly, a qualified opinion will be issued if there is a contravention with the generally accepted auditing standards. In his performance of the audit, his ability to accumulate and evaluate information on the financial to evaluate evidence on the financial information was restricted because of certain things. His ability to audit as an auditor was interfered with. If it was interfered with, he must give a qualified opinion. If he has found himself not to be independent, we said an audit is an independent investigation, an independent investigation of whether compliance was done, then he must give a modified opinion. Yes, let's move on. So we have qualified opinion where people do not abide with the standards. We have a qualified opinion where people do not abide with the general auditing standards, accepted auditing standards. What does that say? You need to understand that. An auditor has also his own standards on how to perform an audit. There's level of, there are methods, prescribed methods of how the auditor must perform his audit. If he is interfered with, or circumstances are such that the auditor will not be able to perform, then he must qualify the opinion. What are the generally accepted accounting principles or issues that may arise during the audit that may cause the auditor not to issue a modified, a qualified opinion? There were changes in how things should be done, and management did not change with the generally accepted. So, and the auditor disagrees with the reasons that management gave. That, for instance, this is how we treat assets next year. Starting next year, we must treat assets in a different way. And the preparers of the financial statements did not recognize that there were changes in the standards, and the auditor is of the opinion that this cannot be allowed to happen, disagrees with information that was brought by management. If the disclosures, if the information given, disclosure are part of the financial statements was not enough. If there were significant departures, that means here we are talking, the first one, we are talking of consistency. You must apply the same valuation method year 1, year 2, year 3. If you are going to be applying FIFO, it must be FIFO year 1, FIFO year 2, FIFO year 3, FIFO year 4. You can't say FIFO year 1, FIFO year, then you say weighted average, then FIFO. Consistency in the application of standards. Are you there?
Yes, sir.
Yes, sir.
Yes.
Sure.
Yes.
Then you have to disclose. You must, whatever information you disclose, the composition of our assets is made up of motor vehicles like this. The disclosures for each area of accounting are specified in the standard, how to disclose each and every. Creditors, you need to go through the disclosure and state the creditors that are in 30 days, 90 days, state the debtors. That's disclosing information in the notes. Was it enough or not? If it's not enough, the auditor may qualify on the basis of this. If there were a significant departure, this is not consistency, but significant things have to be done this way and you're doing them the other way around, the old way around or the wrong way around. Departure from the general accepted accounting practices. And the auditor disagrees with the reason why you departed from the generally accepted accounting principles, then he is allowed to issue a modified report. Or if you misapplied, you applied the principle the wrong way, or you used the wrong standard on the wrong asset to apply it, then misapplication of the generally accepted accounting principles. If you made an unreasonable estimate and the auditor does not agree, then the auditor is entitled to issue a modified opinion or a qualified opinion. A qualified opinion can be qualified, an opinion can be qualified, or it can be adverse. Out of these things, the auditor may issue either a qualified opinion or an adverse opinion. Out of these transgressions that the client has done, the auditor is in a position to issue a qualified opinion or an adverse opinion. Qualified opinion arises where the issue, these transgressions were material, but not severe and pervasive. Material, that means added or removed from the financial statements, would give a different understanding. Is material, but not pervasive. Pervasive means severe or severe means or pervasive. Pervasive means it was affecting all aspects of the financial statements. Severe means it was changing the understanding of the financial statements significantly. If something is not severe and pervasive, that is, it was a localized problem. It was a localized problem. He did not disclose only on debtors that we had a disagreement with. We can qualify and we can issue a qualified opinion and raise that this matter was only with respect to debtors. He did not do the debtors. It had a limit. It affected a limited area and did not alter the fundamental understanding of the financial statements. In that case, we just issue a qualified opinion.
Hey, can you please repeat on the issue? But the issue is material but not severe and pervasive.
Yes, it's material. That means it can affect our understanding of the financial statements, but it's localized. It's limited to one section of the financial statements. It does not, that means it's not severe. It's not severe and pervasive. Pervasive means affecting everything in the financial statement. So the best explanation is this one, limited to a certain area and does not alter the fundamental understanding of the financial statement. Means it's material. It's material. It's worth noting. It will affect, but it's not severe and pervasive. Means does not affect fundamental understanding of the financial statements. You got it? We will keep on talking about it even on Wednesday morning. You will get it as we move on. If the auditor may, because of these transgressions, the auditor may issue an adverse opinion. It's material, severe, and pervasive, can alter the fundamental understanding of the financial statements. It affects all aspects of the financial statements, and it will really have a bearing on how people use the financial statements because of these transgressions that the client has done. In that case, you issue an adverse opinion. Next. There could be gas issues, generally accepted auditing standard issue. The auditor works through being given access to all information as agreed. It is the duty of management to try by all means to provide with the auditor with access to all information so that he's able to accumulate and evaluate evidence. If the
Yes, sir. I'm sorry to take you a little bit back, but I don't seem to understand what you really mean by qualified opinion. The first circumstance that says financial statements are not prepared according to the general accepted accounting principles, and the auditor disagrees. What then happens when the auditor disagrees? You said the auditor then qualifies it. What? I want to understand what that means. Error.
If, remember, at the end of the audit, the auditor must give an overall opinion or on his assessment of the financial statements, isn't it? That's what everyone is waiting for, because he's an independent external person who should give an opinion about what he thinks of the income statement, the balance sheet, the cash flow, and the notes that were prepared, which are prepared into some kind of a booklet. The auditor looks at them and gives us a position as to whether or not we can rely on that. And that position is called an audit report or an audit opinion. First, it can be said to be unmodified. He will say it gives a true and fair view of what happened. That is an unmodified, the one that we started with. Second, the auditor can encounter problems in his accumulation and evaluation of evidence to determine whether these accounts can be relied upon. There are two possible problems, two big groups of problems that he can encounter. First, he can encounter a problem associated with the application of IFRS in the preparation of the accounts. Second, he can encounter a problem with his ability to collect evidence and evaluate it. He was interfered with, whether deliberately or not, and he was put in a posture where he was unable to collect evidence properly, so that he can evaluate that evidence and give us a position on whether the financial statements were in good standing. So two circumstances, two possible things would interfere with the audit. First, we are saying there are issues that as he evaluates the evidence, he may find that there are gap-related issues. Gap-related issues, we mean generally accepted accounting practices issues. The preparation of the records in arriving in the financial statement had contravened some of the rules associated with preparing financial statements. These are gap issues, generally accepted accounting practices issues. He did not follow the standards properly. The client did not follow the standards properly. The client did not understand. The client was not consistent. The client did not disclose. The client did not value things properly. And the auditor is disagreeing with what the approach that the auditor, if the auditor is agreeing, he doesn't have to qualify. He say if he agrees that, oh, the client did not follow the standards, but I understand why, and I don't think it's affecting the truth, the correctness of the financial statement. He only has to issue an unmodified opinion with a paragraph to emphasize that yes, there was a transgression, but I agreed with it. Are you there?
Yes, sir.
But if there was a transgression of any of these, if you can see my mouse, and he does not agree with that, then he's going to issue a qualified opinion. Then the extent of the qualified opinion depends on the severity of the transgression. If it's just not that severe, he just issues a qualified opinion. If it's very severe, he issues what is called an adverse opinion. If it's not that severe, we say although it was material, it was not severe and pervasive. That means although it was material, that means although it needed to be looked at, it could affect the outcome of the financial. But in the whole, it was only done in a limited area of the whole system of financial statements, and we don't think it will fundamentally affect anyone who's looking at the financial statements, the understanding. But if you looked at the severity of the transgression, and he sees that it was material and it was severe and pervasive, it was all over in the financial statement, there was no regard to the rules, and it has fundamentally affected the presentation and the reporting of the information, he issues what is called an adverse opinion. Are we together?
Yes, sir. Thank you.
Yes. And as you thank me, let's pack it there for today. When we meet, we'll do the gas issues, generally accepted accounting, auditing standard issues that can cause the auditor to issue a qualified opinion when his restriction is restrained, whether deliberately or not deliberately. Then we'll go through issues of attestation and assurance services, and we close the introductory part of the course outline. I take it that those who had sent me an email for me to include them, I've done the appropriate, I've done that, and we take it from there.
Sir.
Yes, sir.
Open notes, sir.
Yes. I'm delaying because I'm still fixing them. It was I'm still fixing them so that you don't get an outdated version.
All right.
Thank you. Thank you very much, ladies and gentlemen.
Sir. How do you add us on Teams? I didn't hear that.
You send me your ID number on my email.
And the email is
in front of my Tobeza@UB. My name and G@UB, and you do the rest.
Thank you.
Yes. Bye, guys.
Bye,
Bye,
sir.
sir.
Sure.
Bye.
Hi.
Rosie.
Aritobeta. Tobeta.